And once again, I'll just quickly reintroduce myself. I'm Lori Rothman. I'm an anchor with the Fox Business Network. I'm so honored to participate in the Simon School of Business New York City Conference. Today, as you know, this year's theme, Reform at a Crossroad, Economic Transformation in the Year Ahead. So during this session, we'll look at the global impact of reform with 3 distinguished Simon School alumni, continuing with the themes you've all been discussing throughout the day today. Jay Bennett is the Vice Chairman and Chief Financial Officer of the Travelers Companies. Arunas Chesonis, I'm totally butchering it, and I was practicing it all morning. I apologize. Anyway, Arunas is the CEO and Chairman of Sweetwater Energy, and Alan Zekelman is the Director of JMC Steel Group. Gentlemen. Okay, so Jay, we'll begin with you. Once again, Jay Bennett is Vice Chairman and Chief Financial Officer of the Travelers Company, sitting right next to me here. You received your master's degree in business administration from the Simon School. You specialized in finance and accounting and received a distinguished alumni award as well.
So you'd like me to talk a little bit about the insurance industry and our company?
The insurance industry, how it's been affected by what so many people are characterizing as the longest economic recovery in history.
Well, let me start by saying in the property casualty industry, which is where Travelers participates, the whole raison d'etre is to provide capital for losses that companies can't afford to take on themselves. And whether it's companies or individuals, we do provide that capital, and as a result of that, we're effectively a GDP company. We insure GDP. So when GDP is growing, our opportunities grow. When GDP is shrinking, our opportunities for providing risk coverage shrink. And we've been in a marketplace, as you've heard other speakers talk about today, where GDP has been growing, but it's been growing at a relatively modest pace. So we do have growth opportunities available to us associated with that modest pace, but there are other factors that we need to look at as it relates to managing our company that are also very important in this particular environment that we're faced with. Fortunately, as a financial services company, we've heard a lot about regulation today. We're not one of the companies that faces a great deal of change in our regulatory environment. We're regulated by the states. We're not regulated by the federal government. Although recently, as part of Dodd-Frank, there is a federal insurance office that's trying to spend some time understanding the insurance industry and how the industry functions. But aside from some of the changes that might be coming down in the future, the regulatory environment really hasn't changed for us dramatically at this point in time. But what has changed is our ability on the left side of our balance sheet to find adequate returns on our investment portfolio. Everything that's taken place in the capital markets, particularly with everything we heard today about the Fed managing interest rates, has caused us to be in a position where if you look at our investment portfolio, which is a little over $70 billion and it's about 93% fixed income, that portfolio, of course, has a maturity schedule associated with it, and it seems that every time something in the portfolio matures, we're reinvesting the proceeds at about 200 basis points less than what the yield was on whatever was maturing. And when you think about that in terms of what that does to our earnings going forward, it's a little over $100 million drag after tax per year, and that's on a round numbers $2.5 billion earnings base. So it's not the lion's share of our earnings, but it's meaningful, and it's a headwind that we and others in our industry face. Secondly, the thing that we face is uncertainty associated with weather. We're in a business, of course, where we insure property, we insure businesses for business interruption, and anytime there's a weather event or a terrorism event or anything associated with catastrophes, chances are a company like the Travelers will be providing some coverage. Now, we have lots of sophisticated models that go through estimates of what kind of events could take place, what kind of losses could we have. We do a lot of work in terms of figuring out, not just what the average annual losses might be associated with that, but really in managing the company, what's the tail risk When you look at events that have a 1 in 100 chance of happening, or 1 in 500, 1 in 1,000, what's that going to cost the company, and how do you develop a capital structure to be able to deal with that? And how do you disclose those risks, in your 10Ks and 10Qs to your customers? But, clearly over the last several years, we've been seeing a changing weather environment, changing weather patterns, whether it was the tornadoes and hailstorms in places like Tuscaloosa and Joplin a couple of years ago, whether it's Irene and Sandy in this area over the last couple of years. These are costly events, and hail, unfortunately, has damaged a lot of roofs in this country, and that's cost us and our competitors lots of money. So, part of what we look at is this lower interest rate environment impacting our earnings. We look at the uncertainty of weather and the costs associated with that. And the reaction that we have had going back at least a couple of years now, and the marketplace has had, has been one where if our capital is going to be exposed, then we really need to raise rates. And we've been in a business that's had the good fortune, I would say, which is maybe different from other businesses in this environment, of being able to selectively, using very, very sophisticated analytical tools that are the hallmark of our company, go into the marketplace and figure out on a very, very detailed basis, what loss exposures we face on an account-by-account basis and adjust rates accordingly. And that's been, successful in terms of being able to expand our margins to hopefully deal with the weather and the net investment income issues. Although, again, when you have storms like Irene and Sandy, that's not built into the pricing to its full extent. At this point in time. So our margins have improved as a result of this, but we'd of course like to see interest rates higher without inflation. We'd like to see the country's economy growing in a productive way, and it would be nice if the sun would shine.
Thank you very much.
Thank you.
Jay Bennett, Vice Chairman and CFO of Travelers. So we're going to have time to ask each of our panelists questions, but we want to hear their remarks first. And Arunas Chesonis, I apologize for butchering your name earlier. I was giving a little French accent there or something. Anyway, as the CEO and chairman of Sweetwater Energy, I understand that's a renewable energy company. Is that a fair way to characterize it? And this is such an important industry right now because it's in the dialogue as to whether or not this country can become energy independent in a certain period of time.
Well, it helps the energy sector, but we're really a sugar company. So we take non-food crops like wood chips, the leftover corn stalk after you harvest the corn, sugarcane bagasse after you squeeze the juice out of it, and any of the other feedstocks out there, and we create C5, C6 sugars that can be used for biochemicals, biofuels, bioplastics. And the nice part of our business is it's unlike my last company. The last company was in telecom, and I was used to dealing with people on one-year contracts, $50,000 a year for service. This particular business, we're looking for each customer to spend about $40 million a year with us under 15-year offtake contracts. So it makes it much more fun if you're the CEO, let me tell you, if you can do something like that. And we're also working with MIT right now on some directed research to make sure that some of our initial customers who are in the ethanol business have a way to actually get involved in advanced chemicals and higher value fuels, so that we can migrate them away from ethanol. Because at the end of the day, subsidies is always a word we talk about in the energy sector, and you just have to know that they're going to go away at some point. You can debate whether or not they're valuable or not valuable to get certain industries started, but at the end of the day, they're going to be gone. So we have to plan for ourselves to focus on the higher value products, so we don't have to depend on subsidies at all. But I just want to let the folks know here too that I'm involved in 4 other startups, all in Boston. And I'm active on the board. I work with the young CEOs every weekend. I don't play golf, so that's what I do right now. The kids are older. And it's exciting. One's an ultra-capacitor company, one's a power converter company, one's in transparent solar PV, and the latest one is going to be the most fun. It's a company that's about water purification for all the produced and fracked water coming out of oil and gas wells around the world. There's no real good way to clean that water on site right now that's cost effective. So again, it keeps me up at night. My ADD is gone now. I have no more time to do anything, and it's a pleasure to be here.
Arunas, thank you. Okay, and our third and final panelist this afternoon is Alan Zekelman, Chairman, JMC Steel Corporation. You served on the Simon School Executive Advisory Committee since 2010, and Last year, Mr. Zekelman joined the Simon National Council and the Simon Campaign Committee. He and his wife established the Laurie and Alan Zekelman Professorship of Business Administration at the Simon School. The floor is yours.
Okay, thank you, Laurie. My brother Barry is the chairman, so I better be careful. But that's okay. Don't want to take anything away from him. But nonetheless, my company, the JMC Steel Group, is a pipe and tube manufacturer, so we are gung-ho about making things in the U.S. still, although it seems like everything's moving to China, and I'll talk about that. We produce about 2 million tons a year of pipe and tube, which means we buy about 2 million tons a year of hot-rolled steel. Our company is older than the Ford Motor Company, believe it or not, because, well, I didn't start it then, but we merged with that element of the company. And it has 13 manufacturing plants, about 2,300 employees, over 3,000 pension participants, and over 5,000 healthcare participants. You can imagine where I stand on Obamacare. We manufacture in Pennsylvania. We have 3 plants there. Ohio, 3 plants there. Michigan, 1 plant. Illinois, 2 plants. Arkansas, a plant. Alabama, a plant. And 2 plants in Ontario, Canada. So that's our international part. About half of our business is the manufacture of structural steel tubing. That's the side that's closest and dearest to me. But more new to me, and that's the part that's the 100-year-old part, is the other categories of tube that we make. We make electrical conduit, electrical fittings, standard pipe, mechanical tubing, including drawn-over mandrel, sprinkler pipe, fence post, pipe piling, and lastly, oil and gas pipe for fracking and stuff like that. Don't know much about the water, but anyhow, from the perspective of government policy, imports and currency manipulation come immediately to mind as being problems. Additionally, we're impacted by a high degree of uncertainty on healthcare costs, pension costs, how the deficit will be funded, and lack of an energy policy. These uncertainties translate into low confidence in the long-term economic landscape, which is where big capital projects that drive non-residential construction come from. This is a big part of why this sector has been so long in recovering as opposed to many other sectors. Unfortunately, our business is basically highly correlated with non-res construction, which is, I guess, a problem right now, but hey, we're hoping for some good stuff down the road soon. Basically, the U.S. government's traded away a lot of manufacturing jobs over the years in exchange for foreign policy consideration and debt service. It should not be that difficult to enforce fair trade practices in exchange for access to the largest market in the world. While even trade between Canada and the U.S. can have its issues, it's a model of how it should work. The special interests of the multinationals, and I know that we have people from big corporations in this room, like Walmart, Caterpillar, et cetera, have distorted this arena to the point of nonsensical rulings and enforcement. Globally, China has swamped the market in additional steel capacity that is seeking a home. Almost every major market worldwide currently has some form of unfair trade ruling against some portion of China's steel products. Phase 2 for China, the way they get around all this, has been to divert steel to third world countries to be formed into a downstream product such as pipe or tube and then snuck into the U.S. Most major markets are just now starting to push back on these products as well, but each case takes years and you have to address each product one by one. In the meantime, these individual markets are destroyed. In addition, for the U.S. market, the biggest single consumer of steel is non-res, that's us, which, as we have discussed, remains in recessionary conditions. Add all of this up, and it becomes a classic case of where supply has overwhelmed demand, much of this as a result of poor government policy. So as someone trained at the Simon School in economic matters, you're trained to really think that regulation is bad, and I do generally think regulation is bad, and you think about fair trade and free trade, or especially free trade. And so generally I'd say I don't want regulation, but frankly one of the things that could be done to help me is to implement regulation that would make it that the trading partners with whom America trades play by fair and even rules. So fair trade is important to be reciprocal, and we are generally pretty fair over here, but it's not clear that things are always done fairly with our trading partners. And so we go to Congress, and we get bills put through, and hopefully some of them will pass and give us some protection. But that's for further discussion, I guess.